new construction, existing properties. So even properties that you've owned for 4 or 5 years, we can still go back and do a cost seg study. We don't have to amend your tax return. We can do what's called a Form 3115. That is a reconciliation, and Eric is familiar with those because we had to do that when he first met me. We had to go back and kind of reclaim. It prevents you from having to file an amended return, so it allows you to bring the old depreciation into the current tax year. So older properties, existing properties, new purchases would be a good candidate. Anytime you're doing substantial renovations, 50,000 or more, leasehold improvements, 50,000 or more. A step up in basis, like Eric was talking about, is when he passes his property on to his children, or through the trust or whatnot, there becomes an inheritance. There is a step up in basis. That would be a great time, because that step up in basis is equal to the fair market value at the time of the inheritance. And so we can do a cost seg study to help minimize the inheritance there, or that tax that they are incurring. And then 1031 exchanges are a great opportunity. We are allowed to apply cost segregation to the excess basis. So as Jonathan was saying, when you do a 1031 exchange, you're purchasing a property, but you're reducing that basis. Your depreciable basis is reduced by the capital gains that you're rolling into that deal. So if you buy a property for $1 million and you bring in $200,000 of exchange money, your new basis is going to be give or take $800,000. And that's where your depreciation starts. We can start a depreciation schedule over again, and we can match up those 5 and 15-year properties from the old or the relinquished property going into a replacement property.